Hi, Denise Naylor here, and welcome to my video series House Purchase Loans Buy Your Own Home Part 3, Borrowing from a Bank. Have you noticed that when something is working well, everyone wants a slice of the action? Well, the banks looked at the huge success of the building society movement, and someone in a bank boardroom must have thought, I want some of that. Banks wanted to get into housing finance in a big way. Bank directors could see that the building societies had the lion's share of the mortgage markets. Over a period of time, starting in the 1990s, the major banks purchased several building societies, taking on their customers and loan books. Unlike building societies, which we've seen in Part 1 are run for their members only, banks are companies with shareholders. And these shareholders expect profit and appoint boards of directors to make profit on their behalf. Bank customers, on the other hand, want cheap money. This can result in conflict of interest. Building societies avoid this conflict by being run solely for and by members. But in the new, fast-paced, deregulated world of finance emerging from the 1990s onward, that was seen as pretty boring. Previously, bank regulators had required internal firewalls, but these were largely swept away to encourage competition. And bank regulations were slackened further to allow the use of customers' deposits, not simply and safely to support lending to business and customers, but to invest in riskier assets, including speculative development finance and derivatives. And many banks did just that in the pursuit of profit. Freed from the strict lending criteria of the building societies and with new money created from their own new derivative products, banks were lending to some people who turned out to be less able to repay the debt. Bank shareholders were happy, bank borrowers were happy. House prices were rising, so homeowners were happy. What could possibly go wrong? Over time, the easier cash resulted in house price rises. To fund your higher house price, you had to take on more debt. Builders could not build enough houses quickly enough to meet rising demand. House prices rose again. Eventually, the bubble burst, leaving the banks with loan books full of unrecoverable debt. And in September 2008, banks started reporting to their regulators that they were in trouble. Depositors queued to take their cash out. Governments in the US and the UK stepped in using taxpayers' money to prop up the banking system. So how do you buy your own home with bank borrowing today? Today, banks are more heavily regulated. You will have to give more information about yourself and your finances before you can get bank finance now. Bank loans are more expensive as the banks shrink loan books and have to find cash to pay fines for their past behaviours. Some banks use mortgage or finance brokers as agents for them. So you may have to pay a fee to the broker additionally to any fees you pay to the bank for your loan. Nonetheless, bank borrowing is a good place to go if you have a business or you want a buy-to-let mortgage or a commercial loan. And the Bank of England Financial Conduct Authority reported that for Q4 2016, gross lending totaled £62,828 million and net lending £11,271 million, of which 66% of this lending was for house purchase, 13.93% was for buy-to-let purchases. So you can see that the banks are big players in housing finance, especially for buy-to-let loans. So if you are a business owner, or wealthy already, or looking to purchase a buy-to-let property, or perhaps a commercial property, bank finance may be your natural first option. Thanks for listening. In part 4 of my series, House Purchase Loans Buy Your Own Home, I'll introduce peer-to-peer funding, something that I believe you'll see a lot more of in future. And do join me again.